In this video, I am going to show you how simply being married to someone can save you a fortune in taxes and can even be used as a wealth building tool. Married taxpayers pay lower taxes, take larger deductions, and can even create their own deductions together through businesses, real estate, retirement planning, and so much more. These tax benefits are so beneficial that I even have clients that literally decide to get married after learning these tactics, which is crazy. But today I want to reveal all of this to you as a licensed CPA that tax plans every day at mycpacoach.com. So let's jump right in. Okay, so let's start with the easy stuff like number one, lower income tax rates. Married taxpayers are literally able to get 2 times more income into almost every tax bracket when compared to single taxpayers. Just take a look for yourself. Single taxpayers pay a 22% tax on incomes above $50,000, while married taxpayers pay a 12% tax on their income until it's $100,000. Single taxpayers pay a 32% tax rate once their incomes exceed $200,000, while married taxpayers do not pay this tax rate until their income exceeds $400,000. That's a huge difference. And these big differences are in almost every tax bracket. For example, a single taxpayer with $400,000 in income would pay $92,000 in federal income tax alone. But if that same person was married with the same amount of income, their taxes would drop to just $73,000, giving them nearly $20,000 in tax savings due to a simple change in their filing status. And it's a similar story for number two, lower capital gains rates. So single taxpayers pay a 0% tax rate on their long-term capital gains when they report less than $50,000 in income. But married taxpayers can have nearly $100,000 in income and still pay a 0% long-term capital gains rate, which is a big deal. I have clients who literally pay zero taxes through this 0% rate because all they do is live off of their long-term capital gains from maybe selling some stocks each year or earning qualified dividends, which are also taxed at the same rate. So getting a 0% tax rate on up to $100,000 is a big deal. Plus, the difference is similar throughout other long-term capital gains rates, ranging from 15 to 20%. And that's just the beginning. Married filers also benefit from number three, higher standard deduction amounts. Married taxpayers get 2 times the standard deduction amount of single taxpayers. In 2026, single filers get just a $16,000 deduction, while married filers get a $32,000 deduction. This simple filing status difference could save someone in the highest tax bracket nearly $6,000 in taxes alone. So not only are married filers paying lower rates of taxes, but they're also getting higher amounts of deductions without doing anything at all other than simply filing as married. Plus, there's number four, higher tax credit eligibility. Almost every major individual tax credit or deduction has an income limit. And when you are married, you also benefit from higher income limits, allowing you to take advantage of more deductions. For example, new deductions that just came out, like the new tips deduction and overtime deduction, have income limits. Single taxpayers can take these deductions when they earn less than $150,000 of income, while married taxpayers can take these deductions on up to $300,000 of income. That's a big difference. It's a similar story for tax credits like the child tax credit or educational tax credits like the American Opportunity Tax Credit or the Lifetime Learning Credit, for example. Married filers are able to qualify for these tax credits while reporting nearly twice as much income as single taxpayers. And it's even like this with business deductions like the QBI deduction, for example, which literally allows business owners to deduct 20% of qualifying incomes. Single filers automatically qualify when they earn less than $200,000 in income. But if you are married, you can qualify with twice as much income at $400,000. Almost any tax deduction or tax credit that has income limitations are usually more beneficial for married filers because they have the ability to earn much more income while claiming these income-based tax incentives. This is even true when selling your home. So let's talk about number 5, higher housing gain exclusions. Section 121 of the Internal Revenue Code allows you to sell your primary residence and exclude a certain amount of your gains depending on your filing status. If you are single, then you will be able to exclude up to $250,000 of your capital gains from your income. But if you are married, you are able to exclude up to $500,000 of your capital gains from selling the same exact residence. So for example, if you bought a primary residence for $300,000 and 10 years later, it somehow became worth $800,000, you could sell it, earn a $500,000 profit, and owe zero tax on the transaction with this exclusion if you file as married. And again, we still have not even done anything yet. These are all simple tax benefits that almost anyone would qualify for by simply filing as married with a spouse. Now, let's level this up a little bit here and talk about ways to use marriage to create more deductions on top of all of this, starting with number 6, creating business deductions. So when you operate a trade or business, you can typically write off any ordinary and necessary business expense you incur to operate your business. And sometimes adding your spouse to your business can actually increase what you can actually write off. For example, if you and your spouse go out to dinner and you all talk about business, that dinner is not tax deductible if your spouse is not a legitimate business contact. But if your spouse was involved as a partner or employee of that business, you might be able to write off that same meal, assuming that there is a legitimate business discussion taking place. The same is true for many other types of deductions, like expenses tied to your business travel, board meetings, and even education-related expenses, and so on. Your spouse simply being involved in your business as a legitimate business partner or employee may open up the door for you to take more business deductions. Some people even go as far as creating an entire family management company where the family, including the kids, are involved in managing various aspects of business operations while receiving a number of different tax benefits. Like number 7, for example, creating retirement deductions. So whether you have a business or not, if you and your spouse participate in retirement plans, the tax benefits you both receive will be reflected on the same tax return if you both file together as jointly. So in general, filing married with a spouse might allow you to claim 2 times more retirement deductions on your tax returns. But when you hire your spouse as an employee in your business, it can be increasingly more beneficial for you because business owners are able to contribute much more towards their own retirement plans through various plan structures. For example, a solo 401k might allow you to contribute up to $80,000 into your own retirement plan depending on your age and income. And if your spouse was involved in your business as well, you might be able to get twice this amount into your plan, granting you a $160,000 deductible contribution. Some of my higher income clients will even go as far as setting up pensions and cash balance plans that would allow them to contribute upwards to $300,000 per person towards their retirement in one given year. Which means if your spouse was involved, you might be able to contribute upwards to $600,000 together towards you all's retirements in one given year. And I do have clients who actually do this. But there is some nuance to the tax rules, and your contributions may be limited on things like your age, income, plan structure, and so on. But if you want to learn more about that, just comment retire below. Now, another way savvy taxpayers use marriage to reduce their taxes is through number 8, using real estate losses to offset their income. People are literally using their spouses to take huge real estate deductions and losses on their tax returns. And here's why. Most real estate investors are actually unable to use their real estate deductions and losses to offset other income on their tax returns. The IRS says that unless you qualify as a real estate professional or meet other specific criteria, your rental activity is considered passive, which cannot offset your earned income that you may earn through a W-2 or business, for example. But qualifying as a real estate professional is as simple as meeting a time and participation requirement. But one thing a lot of high income earners and business owners do not have is time and participation to actually meet this criteria. So what married taxpayers are doing is that they will set this up in a way where there's one spouse that earns W-2 and business income, and another spouse that is set up to manage all of their rental activities so that they can meet the IRS requirements as a real estate professional, which would allow them to classify the entire activity as active instead of passive, which opens up the door for them to use their real estate losses against their other active or earned income. For example, let's say you have $175,000 of earned income, maybe from a W-2 or business, in an investment property that is reporting a $75,000 loss due to depreciation claimed through cost segregation. Well, without meeting certain criteria, none of that $75,000 loss would be able to offset your earned income. But if your spouse qualified as a real estate professional and filed jointly with you on your tax return, that $75,000 loss would turn into an active loss, allowing you to reduce your earned income with it to just $100,000 instead of $175,000. And we see people use this strategy all of the time, where one spouse earns the W-2 or the business income, while another spouse acts as the real estate professional, allowing them to offset a ton of money in taxes together. Now, there is a lot of red tape around all of these strategies, really, and I would never recommend that anyone watching this to attempt this without professional guidance. And if your CPA is not helping you do things like this throughout the tax year, just apply to work with my team today at mycpacoach.com.